In this week's update, the more commodity prices fall, the more I like them. US strength is amazing, but very narrowly focused. Semiconductors roar as AI euphoria takes hold. And what would debt default do to stocks? My name is Gary Davis. As always, this is general advice only. And please remember to like and subscribe to the video. It's a market that is hard to feel really confident about at the moment because of this overhang of US debt default and the fact that the US market has been quite positive in the last short period. So let's have a look at the positives and the negatives in this rather confusing market. So US earnings forecasts, not the earnings themselves, but the earnings forecasts, so the outlook for the next 2 to 3 quarters, have stopped declining. So analysts have stopped downgrading the earnings forecasts. The Nvidia spike in price reveals that there's a much greater risk-on sentiment has now entered the market than what we had before. If you look at the individual share prices of a lot of the semiconductor stocks, they're just simply amazing. And on huge volumes as well. Now, commodities are soft right now for a bunch of reasons that I've been talking about now for some time, but that is short term. It's temporary. The long-term outlook is just amazingly bullish across most commodities, and particularly those associated with battery metals. Let's look now at the negatives, and there's numerous other positives as well. I'm just trying to pick the ones that I think are the most relevant. The market breadth is something I've been talking about for a few weeks now, and it's still the case, as you'll see from the charts. This is a market being led by a relatively small number of stocks. Although I must admit, in the last week, that did definitely broaden, particularly in the semiconductor and AI space. Corporate margins are at a historic peak. The percentage of profits relative to revenue. Now, that doesn't mean that they have to fall, but it's going to be hard for them to go up any further and therefore lead to expansion of PE ratios. The US is in financial decline. You've only got to just step back and look at their debt, their runaway debt, and you can't reach any other conclusion, but the US is in financial decline. And there's also massive social divide in America as well. You're seeing it in politics, and increasingly everyone who used to be in the middle seems to be moving to one side or the other, and they're standing there hurling insults at each other. So there doesn't appear to be the capacity to reach compromise in America, and that's not a good thing. And then, of course, we've got the unknown consequences of a recession, be it in America, in Australia, globally, because tightening credit conditions, which is what we've got, and in this case, some of those tightenings are due to market forces, not due to choice, to head off inflation. So that is never good for a buoyant stock market. So there's some of the positives and the negatives to sit back and contemplate. The balance for me has to favour caution, unless you're just a real renegade stock trader that doesn't care too much about the ups and downs. I think you have to be erring on the side of caution at the moment. So the conclusion that I come to is that the data and the logic always lags, and there's certainly a lot of things happening in the market that defy the data and certainly defy the logic at the moment. And that's always the case, and I've talked about that forever. The fact that if you want to try and trade the news, or if you want to trade what is logical, then you're probably not going to come out too well on that side. How you respond is a matter of your time frame for operation and also your game plan. If you're a shorter term thinking kind of person, not too resilient to a lot of market volatility, then you probably need to be holding higher levels of cash and be very, very conservative at the moment. there are a number of factors out there, but certainly the debt ceiling fiasco is one that could cause a great deal of volatility in the market. But if you've got a much longer time frame and you are targeted on the mega trend areas of the market, and you're pretty resilient to volatility, then I think this is a time where there's just superb opportunities. So how you respond to that is very much an individual thing, and I would encourage everyone who listens to this video to think about their own circumstances and not just take some prediction from some forecaster about what they think is going to happen, because that might have no relevance to them whatsoever. And it's hard to see, and we've been to this edge of the cliff so many times, but if there is a debt default, even if it's only for a few weeks, until everyone comes to their senses in Congress, then it does change everything. And if you go back a decade or so to similar circumstances where everyone tiptoed to the edge of the cliff, it did disrupt the stock market, and the indexes did fall by, from memory, somewhere between 15 and 20%. So it doesn't have to go on for a protracted period of time to have an outsized impact on the market. But certainly the market at the moment has developed a real risk-on sentiment, and that helps propel it against some of these other fears. Now, China, everyone knows, is so vital for Australia and certainly for our stock market. And one of the things that is encouraging about China is that there is some early evidence of increasing money supply in China, and that tends to be a very good forward indicator. Now, there's a fair old lag there. It can be anything up to 6 months lag, but at least that process of easing the credit conditions, increasing the money supply is always good for the market. There is more focus in some commodities, and copper is one example, but it's not the only one. There is more focus on mergers and acquisitions than on exploration. The really, really big bucks that are required to increase the size of production in copper, nickel, cobalt, lithium, the whole range, is just not happening. It's still not happening, despite all the predictions and all of the rhetoric. The bigger companies seem to be taking the easy way out and looking to acquire additional production to meet demand rather than actually grow the total production. And so when you look at that, you have to conclude that that's got to be a positive for commodity prices, and hence the profit margins of those that are selling into that. All right, the American market had a good finish on Friday, and that brought it back to slightly in the positive, 0.1% across the week. But as you'll see from the charts, it was all about the semiconductors, with the announcement from, or the quarterly report from NVIDIA. But look, NVIDIA and other semiconductor stocks have been moving up for months. This was not something that just suddenly came out of the woodwork. I've been talking about this and following the semiconductor chart closely for the last 7 or 8 months, if you watch this video regularly. So the question in my mind is this new risk-on sentiment justified? And if there wasn't the debt default scenario, I would say probably to a degree. But, underweighting logic, so not placing as much importance on logic is fine. And the logical conclusion here is that with this potential debt default, that we really should be in risk-off sentiment. That's the logical conclusion. But logic, doesn't work most of the time. But I think in this case, it's probably too far too fast when you look at the price reactions in the semiconductor space. But anyway, the market is what it is, and we've just got to observe and respond to that. The US dollar index continues its rebound up to 104.25. The 10-year yield also went up to 3.81, so it was down at 3.43 just a few weeks ago. And yet, despite that, technology stocks have just done incredibly well, and that sort of defies logic as well. The VIX has edged up a little bit, just under 18, but look, that's over the last couple of years, that's still relatively low, and that doesn't make a whole lot of sense either. And there's another one with when I get to gold. So there's a number of very illogical things that are happening. The 10-year, the 10-year, 2-year spread has widened again, so it's even more negative now. Again, just reinforcing the probability of recession. Okay, let's jump in and have a look at some key charts. This is XLK, the overall technology sector. And you can see, look, it was in strong uptrend anyway. We got a breakout on the 31st of January, and we've been forming higher highs and higher lows ever since. Just look at all your moving averages, and then look at the last 2 days, Thursday and Friday to finish the week, and increasing volume as well. So enormously positive on XLK. But this is where the action really happened. This is semiconductors. Again, an enormous session on Thursday, and even better on Friday. And the individual semiconductor stocks are looking incredibly robust. Now, if we look at, I've put the XLK, the semiconductor index, and the S&P all on the one chart, and this is going back 12 months. Now, that doesn't look too much like semiconductors are really killing it, but let's zero in a little bit. So we'll go from the last year to the last quarter. You can see the semiconductor index has really started to catch up, but it's when you get down, let's get down to the last month. You can see semiconductors are just absolutely killing everything. And then we'll just have a peek at the last fortnight as well. So the very recent outperformance by that index is quite amazing. Let's go and look at where some of the money flows are going. This is the Nasdaq versus the S&P. So I just want to show you from several different perspectives, how it looks. Now, a lot of these charts are saying the same thing, but they're just being represented. The data's being represented in a different manner. So this is the Nasdaq versus the S&P. Very, very clear, and really, really taken off in the last 4 weeks. This is semiconductors versus the S&P. It's not much argument about where the strength and the money flow is going. And this is why I've been increasingly bullish all year since this run started. Down around here, we'd started to move up, started forming higher highs and higher lows, and I've been cautiously bullish and increasingly bullish all year, largely because of this. Because, to my knowledge, there is not a bull market that happens without the semiconductors being one of the leaders. So that was why I've been tending on the bullish side all year, despite an awful lot of negatives. But there is a but, and I'll get to that chart in just a minute. This is the chart of the various sector indices over the last quarter. So XLK really outperforming. Consumer discretionary, communication services, XLC. So they've been clearly the leaders in recent times. You've really got to go back to April. Consumer discretionary, but that's largely Amazon contributing to that. And then we've got staples. Healthcare is surprisingly weak, and that's another illogical factor in this market. The defensive stocks are actually being sold. It's not just that they're underperforming, but they're being sold off. They're going lower on an absolute basis as well as a relative basis. And then we've got materials, energy and finance bringing up the rear. But this is what still sort of keeps me somewhat on the cautious side. and that's the small cap growth versus small cap value. And there's really no particular bias there. And if we look at, if we go to IWM, so we actually look at the small caps, you can see they're not really doing much. So the breadth is still definitely an issue in the States. Let's just do a quick check on the currencies. So this is the third week in a row now. We've had real strength in the US dollar. But if this debt default thing gets any more significant, then this US dollar is not going to be hanging up here. If there's any threat of the US not being able to make bond payments, then the US dollar is going to come down and come down pretty sharply. But clearly, from all the charts that you've seen, the market is betting that that's not going to happen. That yet again, this debt ceiling debate is going to end in a last-minute compromise, and maybe it will, maybe it won't. But I'm not someone who hopes for the best. I try to control the risk as much as I can. Now, if we look at the Australian dollar, so we had quite a sharp move down for the last 3 days of the week, and finished in the mid 64s on the cross rate. Now, turning to Australian stocks, 64.58 where our dollar finished. Our market was down, or our index was down 1.8% across the week. A lot of it was in the major miners, which to my eye are overreacting to the Chinese data. I think increasingly we're going to see improvement in China. Yes, iron ore was down, and that contributed to it, but it wasn't down by the amount that I think warranted the fall in our major miners. And I'll show you the iron ore chart in just a minute. Now, China's got the advantage that inflation is quite low, and so they can do whatever they like. I mean, they do normally, but because inflation is not an issue, then that's one less barrier that they've got to worry about. So that's one of the positives. Let's take a look at the iron ore chart. So you can see over the last, it did fall last week, but 110, slipped under 100, and then bounced a little bit, finished up at 102. When you look in the context of the last 6 to 12 months, not that big a move. So I think that was a bit of an overreaction, and I think we might start to see a bounce back next week in the Australian market. All right, turning now to precious metals. Gold was down again, so this is the other head scratcher, the other illogical thing. Wouldn't you think, with all the issues, the possible US default, that gold would be above $2,000 an ounce and possibly a lot higher? And it's going the other way. Now, part of the reason it's going the other way is because the US dollar has risen, but that's not all of it. The gold price has been sold off by more than the US dollar has gone up. So that's another illogical part of the puzzle. In Australian dollars, though, because our currency has come off sufficiently, we've managed to edge up a little bit more, and holding just above 3,000 in Australian dollars. When you look at stocks globally, wherever you want to look at gold miners, it was a pretty poor week all round, and certainly not too flashy in Australia as well. But you know what? This is when you want to get alert, when prices are falling, but the long-term outlook looks good. And I'm not saying that necessarily with respect to gold, but certainly with other commodities where their long-term outlook is very robust. This is when you need to get interested. When people are selling, they're selling emotionally, they're selling irrationally. That's when you want to get ready to step up to the plate. All right, let's have a look at the gold market. All right, this is the gold chart on a weekly basis. So it was only 4 weeks ago that we spiked up to almost 2,100, new all-time high. but since then it's been pretty much all downhill. How much of that is good old manipulation that's been going on in the gold market for decades? I don't know, but certainly it doesn't make a whole heap of sense to me. And that's gold on the daily chart. And if we look at silver, big rebound in silver on Friday, but it had also encountered a lot of selling pressure. And if we look at GDXJ, we've come down from, this is the US ETF, we've come down from nearly 44 and closed the week at low 36s. That's a fairly big drop for a global ETF. All right, turning to other commodities now. Copper is really under pressure, and this is where I'm getting really excited, because stocks are getting hammered on this lower copper price, which okay, there's some reasons for the short-term softness, but the long-term outlook is really good. Now, if we look at copper and the long-term outlook and the likely direction of the price of copper, Chile supplies around 25% of the global supply, and it's falling because of mine depletion. So they've got some of the biggest copper mines in the world, and those copper mines are old, and the grades are dropping and the production rates are dropping. There's also a number of other headwinds, which I won't elaborate on, but there are multiple headwinds in Chile apart from the nationalisation issue that are around operational issues they can't do anything about. You know, the grades and other issues with the operations. And then if you add in Peru, which represents around 10% of global supply, and the civil unrest that there is in Peru, then you can see that there's a bit more than a third of the total copper supply is under question at a time when supply needs to be ramping up dramatically, and it's going the other way. There are other hurdles for supply, one of which is I spoke about earlier, and that's the fact that so many companies seem to be paying more attention to mergers and acquisitions than they are to grassroots exploration. So there's lots and lots of reasons why the copper price in the medium to long term is going to be significantly higher than it is now, and the prices of copper stocks is going to be much, much better than it currently is. There'll be a point where sentiment will flip over. It's not right now. West Texas Intermediate crude was at 72.9, so not a lot of movement there. Let's look at the important lithium market. It was a big week of very positive news in lithium. There's a 5-year deal between Albemarle and Ford. There are three-way deals being done involving Ford and Tesla around the supply of superchargers, and that's I think a big plus for the uptake of electric vehicles, and hence demand for lithium. We've got more analysts that are now significantly raising their lithium product prices in 2023. So we certainly seem to have turned in the cycle in terms of sentiment. And then we've got a Chinese battery maker who makes the following claims: that they've now got a battery, or soon will have a battery, that will provide 1,000-kilometre range, 15-minute charging times, and a 4 million kilometre life cycle. Can you imagine what that is going to do to the uptake in electric vehicles, and therefore the demand side for commodities? Now that, may or may not be something that's ready to hit the market now, but that is an absolute game changer and just makes the situation for supply and demand that much more attractive. And then, of course, we've got more nationalisation moves in Chile. So whether the current president, I think it is, of Chile, can actually get this through or not, the fact is he's still heading even further down that pathway. So that's the situation with respect to lithium. There's the spot copper chart. We did get a bit of a rebound late in the week, but it's been, a fairly significant fall from above $4 down to around $3.60. This is certainly part of the reason in the short term inventories are rising, and I think part of that is demand and imports into China. But if you look at the longer term, it's hard to see that being sustained. There's the spot nickel chart, so it looks fairly similar to copper, a bit of a tick up at the end of the week. But interestingly, the inventory levels in nickel have not really budged. They're at low levels, they're at historical low levels, and not turning up. So wrapping it all up, last week I said this is the best commodity environment that I've ever seen, speaking on a medium to long-term view. And now with commodity prices falling even further and stock prices in those commodities falling further, then I'm going to double down on that, because this is when you really want to get interested. However, you've got to have a plan around this, because the journey is going to be pretty bumpy. It's going to be quite volatile. So don't just start buying stocks because the outlook in 12 months' time is going to be so much better. Because prices can and do fall further than would seem reasonable. The best time to buy commodity stocks is when people are scared. The outlook is confused. The sentiment is negative. That's the best time to buy commodity stocks, and that's either where we are now or where we're close to, depending on how you interpret it. So definitely, in my mind, a time to be getting your commodity plan in place. Portfolio analyst last week, we looked at the methods of analysing mining stocks, and also what the US-Australia deal means for us in terms of the IRA, the Inflation Reduction Act in the States. What does that mean for Australian mining? And obviously potentially amazing, but we've still got to do our part as well. So that's it for this week. As my email address and more information on the website. And look, the crunch is really coming with the US and the debt ceiling debate this week. Unless I think some significant progress is made, then the market really has a right to be getting exceedingly jumpy. And it's a long weekend in America, so nothing will happen on Monday. But this is getting very, very close to crunch week. So I'm sure by next Sunday I'll be able to give you a perspective on that. That's it for this week. Cheers.